Welcome to the Deep Dive, where we unpack surprising connections that can transform your understanding of the world and today, perhaps, your portfolio.
Yeah, we're tackling a question that might sound a bit out there at first.
Definitely. What on earth do Charles Darwin's theories on evolution, the foraging habits of a bumblebee, and maybe even the domestication of a silver fox, what do they have to do with making smart investment decisions?
Well, the investing world often feels like a chaotic gamble, doesn't it? You're hit with headlines, expert calls that just don't pan out.
Right, and that stat about dirt-throwing monkeys sometimes beating the pros, it's humbling.
It is. It makes you wonder, is there a better way?
Yeah.
A more sort of foundational approach to building wealth that lasts?
Absolutely. And what if those secrets aren't in some complex algorithm, but hiding in plain sight? In the natural world, maybe, looking at its principles of survival, adaptation, sustained growth.
Exactly. That's the core idea we're diving into today. We're looking at Pulak Prasad's really fascinating book, What I Learned About Investing from Darwin.
And this isn't your typical finance book, is it? It offers a really different perspective.
Totally different. It uses these powerful analogies from evolutionary biology to shed light on why, frankly, most fund managers struggle. And, more importantly, how you can avoid those common mistakes. Become what Prasad calls a permanent owner.
A permanent owner. I like that. And this different lens feels really necessary, especially when you look at the numbers.
The data is stark. That 2021 S&P report, looking at the U.S. market, something like 75 to 90% of domestic funds underperform the market.
And that's not just short term, right? That's over 5, 10, even 20 years.
20 years.
Yeah.
Think about that. These are smart people, advanced degrees, managing trillions. And the vast majority can't beat a simple index. It's a pretty profound failure of many traditional methods.
It really is. So what's our mission today, then? How do we use this Darwinian perspective?
Our mission is to explore how you, thinking like a permanent owner, someone in it for the long haul, can apply these principles. We're zoning in on 3 core ideas.
Okay, what are they?
First, the absolute necessity of avoiding big risks. Seems obvious, but it's key. Second, the idea of buying high quality at a fair price. Simple phrase, but tricky in practice.
And the third?
The third is maybe the most counterintuitive, embracing extreme patience. Or, as Prasad puts it quite provocatively, don't be lazy, be very lazy.
Be very lazy. Okay, I'm intrigued. So this is a path towards maybe defying those poor performance odds we just talked about.
That's the goal. It's about being truly equipped for enduring success, not just chasing short-term wins.
All right, let's jump into that first Darwinian pillar then. Avoid big risks. The skill of not losing money.
This sounds, like investing 101, doesn't it?
It does. Every beginner hears it. But it's arguably the hardest thing to actually do consistently.
Why is that?
Because the real insight here, drawn from nature, is that long-term success isn't about being the flashiest winner. It's about relentlessly avoiding those mistakes that can take you out of the game completely.
Mastering the skill of not losing money rather than just making it. Precisely. It's Warren Buffett's rule number 1, never lose money. And rule number 2...
Don't forget rule number 1, classic.
Exactly. And what's amazing is how nature itself just lives this principle. Take deer, for example.
Okay.
They've survived millions of years with predators all around. How? Not by being the toughest, necessarily, but by being incredibly sensitive to what biologists call type I errors.
Type I errors. That's like seeing danger when there isn't any. Or, wait, no, the other way around.
It's underestimating a threat. It's the error of commission thinking something's safe when it's deadly dangerous. Imagine that deer at the watering hole. One slip-up, one moment of letting its guard down.
That's it. Game over.
Right.
Yeah.
That single mistake is fatal. So evolution has wired them to be hyper-vigilant. Now, this means they make a lot of type 2 errors.
Which is?
Errors of omission. Like maybe they avoid a perfectly safe patch of grass because they're too cautious. They miss out on an opportunity.
But they survive.
They survive. They'd rather miss a meal than be the meal. That caution ensures the species continues.
And it's not just about predators. You mentioned stags. During mating season.
Yeah, think about it. They have these huge antlers, they posture, they lock horns. It looks fierce. But actual serious fights that could cause major injury, they're surprisingly rare.
Why? Seems like a big prize is on the line.
It is, but getting seriously injured is a massive type I error for a stag. It could mean death, or definitely no more mating. So they have this instinct to avoid that catastrophic outcome, even if it means sometimes backing down or missing a chance. Survival first.
Don't make mistakes that take you out of the game. Applies to stags, too.
Absolutely. And even plants. They seem passive, but they're incredibly successful evolutionarily. They've been around for ages.
How do plants avoid type I errors? They can't run away.
No, but they manage resources. They avoid, say, investing all their energy into growing taller if they're under attack. Instead, they switch gears. Well, if insects attack a willow tree, it ramps up production of these tiny protective hairs, trichomes, or black mustard plants. They start making more of these pungent chemicals, glucosinolates, to deter attackers.
And that takes energy away from growth.
A lot of energy. It's metabolically expensive. But it's a signal, a commitment to survival now over expansion later. They're avoiding the fatal error of ignoring a threat.
Okay, so bringing this back to investing, how do we apply this deep caution? It starts with acknowledging the cost of being wrong, even for the best.
Absolutely. Look at Buffett. He's open about his mistakes, losing hundreds of millions on Tesco, or that huge $4 billion loss selling airline stocks during COVID.
He just admitted, I was wrong.
Right. And the lesson isn't just the number. It's the importance of recognizing you were wrong and cutting those losses before they become devastating. You have to survive your mistakes.
Which leads to this counterintuitive idea you mentioned, the great rejector paradox. This sounds interesting.
It really flips the common wisdom. Most people think investing success is about picking the winners. But let's run some simple math.
Okay, lay out on me.
Let's say you're a pretty good investor. You're right 80% of the time. That means you correctly spot good companies 80% of the time, and you correctly reject bad ones 80% of the time. Sounds great, right?
Yeah, 80% sounds fantastic.
But here's the rub. Let's imagine a market with, say, 4,000 companies. And maybe only 1,000 of those are actually good investments. The other 3,000 are bad.
Right, most companies probably aren't great investments.
So your 80% accuracy means you correctly identify 800 of the 1,000 good companies. 0.8 1,000 equals 800. Good start.
Okay.
But you have that 20% error rate on rejecting bad companies. You incorrectly accept 20% of the 3,000 bad ones.
Uh-oh. So 20% of 3,000, that's 600 bad companies you mistakenly think are good.
Exactly. So the pool of companies you actually select isn't just the 800 good ones. It's those 800 plus the 600 bad ones you accidentally let through. That's 1,400 companies in total.
Wow. Okay, I see where this is going.
So the probability that any given company you actually invested in is truly a good one, it's 800 divided by 1,400, which is only about 57%.
From 80% accuracy down to 57% success rate on actual picks. That's a huge difference.
It's massive. And the key takeaway is the real skill isn't just picking winners. It's being incredibly good at rejecting the losers. That's where you gain a sustainable edge, because most opportunities out there are actually traps.
That really does flip the script. And speaking of avoiding traps, what about turnarounds? Buffett wasn't keen on them, was he?
No, he had that famous line, when brilliant management meets a terrible business, it's the business's reputation that remains intact. Basically, the bad business usually wins.
Trying to fix a broken business is incredibly hard.
Extremely hard. Look at the contrast between Lou Gerstner at IBM and Ron Johnson at JCPenney.
Right. Gerstner came from, what, biscuits? No tech background, but he turned IBM around spectacularly in the 90s. Stock price went way up.
Sevenfold jump. He cut costs, changed the culture. A huge success. A rare one.
Then you have Ron Johnson. Stellar reputation, right. Target, the Apple stores. Everyone thought he'd work magic at JCPenney.
Exactly. The market cheered. Stock jumped 24% just on the news he was hired. But his changes, like getting rid of coupons people loved, they backfired massively.
Sales plummeted.
Crushed. Down 25% in a year. Huge operating loss. He was out in 17 months. And JCPenney eventually went bankrupt.
So even a star manager couldn't fix the underlying issues of the business.
Precisely. It highlights how risky betting on turnarounds is.
Yeah.
The underlying economics of the business are often just too powerful.
Okay, another big risk. Debt. The book argues we should basically detest debt, right? Even though finance theory talks about optimal leverage.
Yeah, that optimal leverage looks good on a spreadsheet, maybe, but in the real world,
Yeah.
it's incredibly dangerous for long-term survival.
COVID really showed that, didn't it?
It was a stark lesson. Companies loaded with debt Hertz, J.Crew, Neiman Marcus, JCPenney, again, they went bankrupt. The competitors with clean balance sheets mostly weathered the storm. It's simple. Hard for an unleveraged business to go bust.
And it's not just about avoiding bankruptcy. Debt kills flexibility.
Absolutely triples it. Look at Asian Paints in India, major paint company. During the worst COVID lockdown in 2020, the revenue dropped over 40%. Disaster, right?
Sounds like it.
But they had zero debt and a big cash cushion, around $220 million. So what did they do? They increased employee salaries. They paid to sanitize their dealer shops. They gave medical insurance to painters who were crucial to their business. They extended payment terms to dealers.
Wow. Well, their competitors were probably just trying to survive.
Exactly. That strategic flexibility, only possible because they had no debt, built incredible long-term loyalty and strengthened their market position immensely. They played the long game because they could afford to.
So management should focus on business risks, not worrying about interest payments.
That's the core idea. Businesses face enough uncertainty, recessions, competition, changing tastes, regulations, lawsuits, you name it. Why add the existential risk of debt payments on top of all that? A strong balance sheet is freedom. It maximizes safety.
Okay, avoiding debt. What about companies that are always buying other companies? Ignoring M&A junkies, that's another principle.
Yes, and the data here is just brutal. Study after study, HBR, KPMG, McKinsey finds that something like 70 to 90% of mergers and acquisitions failed to create value for the shareholders of the acquiring company.
70 to 90% fail. That's astonishingly high. Why do companies do it then?
Often it's driven by hype, CEO egos wanting to build empires, and, let's be honest, huge fees for the investment bankers orchestrating the deals. Not always sound strategy.
Got an example.
The Bayer-Monsanto deal is a classic. Huge acquisition. What happened? Bayer's net debt exploded, tenfold increase. They were forced to sell off key assets by regulators. Their focus got diluted. They missed organic growth opportunities.
So serial acquirers are just introducing too much risk?
Way too much unquantifiable risk. That's why Prasad's fund, Nalanda, explicitly avoids them. It's just too hard to figure out if you're buying a lemon or adding unnecessary complexity and financial strain. It's a potential type I error just waiting to happen.
All right, what about trying to predict the future? That Gretzky quote, skate to where the puck will be, doesn't apply in investing.
Generally, no. Trying to predict the next hot, fast-changing industry is mostly a fool's errand. History is just littered with examples.
Like
the UK railway mania in the 1840s. Hundreds of companies went public, stocks soared, then crashed. Most failed due to incompetence or just no real demand.
sounds like the dot-com boom.
Exactly. Late 90s, NASDAQ Q goes crazy. Companies with no profits valued in billions.
Yeah.
Then the crash. How many truly endured? Amazon, Google, a tiny handful. The vast majority vanished.
And India's seen similar cycles in infrastructure, e-commerce, etc.
Absolutely. Billions in valuations just evaporated. Chasing those fast-changing, hyped-up sectors is usually a path to losing money.
So if we're avoiding the fast-changing stuff, what should we look for? You mentioned the boring is beautiful philosophy.
Right. The idea is to prefer stable, predictable industries. Industries where the rules are pretty clear, the competition is sorted out, and change is gradual, not disruptive.
Give me an example.
Think electric fans versus electric vehicles, or maybe boilers versus biotech. The boring industries often have more predictable long-term trends, lower risk of sudden obsolescence. Predictability trumps massive, uncertain potential.
And this cautious approach extends even to who owns the company. Avoiding unaligned owners. What does that mean?
It mainly refers to two types. First, government-owned businesses, especially in places like India.
Why are they problematic?
Because the government's objectives often aren't purely about maximizing shareholder value. They might use a state-owned bank to, say, forgive farm loans for political reasons, or appoint bureaucrats instead of experienced managers. Their goals conflict with a purely financial investor's goals.
That makes sense. What's the second type of unaligned owner?
Certain multinational corporations, MNCs, sometimes an MNC might have a publicly listed company in a country, say India, but then set up a separate wholly owned subsidiary there too.
And why is that bad for shareholders of the listed company?
Because the MNC might channel all the exciting new growth, the best products, or even the top management talent into its private subsidiary, starving the publicly listed one. Minority shareholders in the public company get left behind, with no real power to stop it. The ownership structure itself creates a conflict.
Okay, so wrapping up this first section on avoiding risk. Let's go back to the bumblebee. You mentioned an experiment.
Yeah, a fascinating one. Scientists put these little robot crab spiders on artificial flowers. The bees quickly learned to avoid all flowers that look similar, even the safe ones without spiders.
So they made more type 2 errors, missing out on good flowers.
To absolutely minimize the chance of a type I error getting caught by the predator.
That instinct to prioritize safety over opportunity seems to be the core lesson here for investors.
Exactly. Be hypervigilant, avoid those fatal mistakes, value safety, even if it means missing some potential upside. That's how you survive long term.
That's a really strong foundation. Okay, let's move to the second principle. It sounds simple, Buy high quality at a fair price, the single filter for excellence. But you said everyone claims to do this.
They do. It's like the universal mantra of investing. Ask any fund manager, they'll say, oh yes, we buy quality at a fair price. No one admits to buying junk at high prices.
Huh. True. So if everyone says it, but results vary wildly, people must mean very different things by high quality and fair price.
Precisely. The definitions are all over the map in practice. It's subjective noise, mostly.
So how does the book suggest cutting through that noise? What's the filter?
The key filter, the surprisingly powerful one, is historical return on capital employed ROCE.
ROCE. Remind us what that is.
Simply put, it's the company's operating profit divided by the total capital it uses, basically, debt plus equity. It measures how efficiently a company uses its money to generate profits.
And the emphasis is on historical ROCE, not forecasts.
Absolutely critical. We don't care about promises of future glory. We want to see a long track record of actually delivering high returns on the capital invested in the business. It shows true operational skill, separate from financial gimmickry.
Can you give an example of how ROCE reveals quality?
Sure, compare Costco and Tiffany's. Tiffany's sells luxury goods, high margins, right? Costco is a warehouse retailer, lower margins.
Seems like Tiffany's might be more profitable.
You'd think, based on margins.
Yeah.
But Costco is incredibly efficient. It turns over its entire inventory in about 31 days. Tiffany's takes, wait for it, by 121 days.
Wow, over a year and a half to sell its inventory.
Yeah. That difference in operational efficiency means Costco generates a higher ROCE, around 22%, versus Tiffany's 16%. Costco is simply much better at deploying its capital effectively, even with lower margins. High historical ROCE signals real business excellence.
Okay, so historical ROCE is the filter. Now here comes another biology analogy, the Siberian fox experiment. This sounds amazing. The correlation of growth principle.
This is one of the most incredible long-term experiments ever. Started in 1959 by Russian scientists Belayev and Trit. They took silver foxes, which are naturally quite aggressive, and decided to breed them for only one single trait: tameness towards humans.
Just tameness, nothing else.
Just tameness. They selected the calmest, least aggressive foxes from each generation to breed the next. And they did this for decades.
Well, what happened? Did they just get tame foxes?
They got tame foxes, yes, but they also got a whole cascade of other unexpected changes, physical changes.
Like what?
Floppy ears like dogs, curly tails, patches of white fur, that piebald coloration, shorter snouts, even their hormones changed. Less adrenaline, more serotonin. They started breeding earlier. All sorts of things.
And this was just from selecting for tameness.
Exactly. It perfectly illustrated Darwin's idea of correlation of growth. Selecting for one trait can mysteriously pull along a whole suite of other traits.
Okay, the parallel for investing must be...
If you select rigorously for one key trait in businesses consistently high historical ROCE, you often find it correlates strongly with a whole bunch of other desirable qualities.
Such as?
Things like strong ethical management, smart capital allocation, a durable competitive advantage, maybe even good employee relations. Things that are hard to measure directly. High ROCE acts like a proxy, a powerful single filter that often brings these other good things along with it.
So focusing on historical ROCE saves you from having to tick dozens of boxes individually. It's a shortcut to finding overall excellence.
That's the idea. It simplifies the process immensely by focusing on the outcome of all those good qualities, sustained profitability on capital.
That leads nicely into the idea of robustness and evolvability. How does that link to ROCE in biology?
Well, think about life. It's robust at multiple levels, right? DNA has error checking. Proteins can fold in slightly different ways but still work. This robustness allows life to tolerate small changes, neutral mutations, without breaking.
And those small changes are important.
Crucial. They become the raw material for future evolution. A system that's robust can accumulate these neutral variations, which might become beneficial later when the environment changes. Robustness enables evolvability.
Okay, how do you see robustness in a business?
It's often qualitative, but you look for signals. Does it have lots of different customers or rely on just one or two? Does it have power over its suppliers? Simple supply chains, differentiated products, low fixed costs, few serious competitors, low debt, obviously, and consistently high ROCE is a big indicator of underlying robustness.
So customer concentration would be a sign of low robustness.
Huge red flag. Prasad mentions tracking a company called WNS. Looked good on paper, high ROCE, no debt. But its reliance on its top 5 clients kept growing, hitting 55% of revenue. That's fragile, not robust, even if the market didn't seem to care initially.
And COVID was like a real-world test for this.
Perfect test. The book gives examples, call them Company A, high ROCE, low debt, and Company B, lower ROCE, more debt. When the pandemic hit, Company A adapted, maybe even gained market share, invested. Company B struggled, maybe even faced bankruptcy. Robustness determines survival and adaptation.
It played out across many industries, showing the real value of that financial and operational strength.
And this robustness allows for what the book calls calculated risks and neutral strategies.
Yeah.
It means you can experiment without betting the farm.
Like Sam Walton did with Walmart.
Exactly. His expansion was slow and steady. New stores, small acquisitions like More Value. There were manageable risks, funded internally, not with huge debt. He kept the core business robust while constantly tweaking and expanding small reversible bets.
And the Indian company, Page Industries, the innerwear example.
Perfect example. They made jockey products in India. High ROCE, very little debt. They tried launching a kids' range. It flopped initially.
It hurt them badly.
Barely made a dent. Because they were so robust financially, they could just pull the plug, learn from it, and try again later successfully. That failed launch was a neutral strategy, a small experiment that didn't endanger the core business, thanks to their underlying strength.
But is it possible to be too robust, too cautious?
It seems so. The book mentions a rare case, a high-quality company in their portfolio that just became unwilling to try any new things, any neutral strategies.
So it survived, but didn't grow.
Pretty much. Sales and profits stagnated for a decade. It was safe, debt-free, robust. But its extreme caution meant returns were subpar. So there's a balance, clearly. You need robustness, but also the willingness to evolve carefully.
Okay, we've talked quality, we've talked robustness linked to ROCE. What about the second part of the mantra? What is a fair price? How do we define that?
This is where Nalanda gets specific. They aim for a median trailing price to earnings, or PE, ratio of about 14.9 when they buy.
14.9 PE. How does that compare to the market?
It typically represents a significant discount, maybe 25–30%, compared to broader market indices like the Sensex or Nifty in India.
So they're not looking for deep bargains in bad companies, but excellent companies at a reasonable discount.
Exactly. It provides that crucial margin of safety. It acknowledges that you will make mistakes, and buying at a fair price with a discount helps cushion the blow when you're wrong.
And the Toys R Us story is a warning about ignoring financial robustness, even if a brand seems iconic or cheap.
Absolutely. Toys R Us wasn't killed by Amazon initially. It was killed by the massive debt loaded onto it by private equity. Acquiring FAO Schwarz when they were already weak just made things worse. A great brand means nothing if the financial structure is broken. Buying unrobust businesses, no matter the perceived value, is a type I error.
All right, that covers quality and price. Now for the third and maybe most challenging principle, don't be lazy bee. Very lazy. The power of inactivity. This goes against everything we hear about markets, right? Constant action, reacting.
Completely against the grain. The investment industry thrives on activity, on noise, on predictions. But this view argues that true investing isn't about predicting the future. It's about understanding the present deeply through the lens of the past.
Like Darwin. He didn't have special data, just observed intensely.
Exactly. He drew profound conclusions from existing facts through patient observation. Similarly, investors should focus on understanding the enduring qualities of a business, not forecasting next quarter's earnings or the next market move.
This ties into the idea of proximate versus ultimate causes, another biology concept.
Yes, a really useful distinction. Think about dung beetles again.
Okay, back to the beetles.
They're big horns. That's a proximate cause. It explains how they fight. But the ultimate cause, the why they survive as a species, is maybe their meticulous care for their young, burying dung balls for food. That explains their long-term success.
Or the mites you mentioned, mating multiple times.
Right. The proximate cause is a short first mating. The ultimate cause is that mating multiple times leads to more offspring surviving. Ultimate causes explain survival and purpose. Proximate causes explain the immediate mechanism.
And the investing analogy. Market headlines are proximate causes.
Spot on. Interest rate hikes, port closures, antitrust news, geopolitical drama. That's all proximate noise. It's loud, it grabs attention, it causes immediate reactions. But it's often completely disconnected from the ultimate cause of a great business's long-term success or failure.
Which is?
The boring stuff. The actual business fundamentals. how it makes money sustainably, its competitive moat, its capital allocation skill. That's the ultimate cause, but it's usually too dull for media coverage.
Remember the Asian financial crisis example? Markets tanked.
Dow dropped 7% in a day, FTSE down 6%. Stocks of great companies like Walmart, Microsoft, BP all fell hard. Proximate panic.
And investors who sold.
They likely missed out big time. 6 months later, the Dow was up 25%, FTSE up 23%. Those quality companies bounced back strong. Reacting to proximate noise cost them dearly.
It's like a knee-jerk reaction. HDFC Bank in India, you mentioned, did incredibly well for decades, despite countless interest rate changes by the central bank.
50 times. Rate hikes, rate cuts. It didn't matter to the ultimate cause, which was the brilliant, consistent leadership of CEO Aditya Puri building an exceptional bank. The proximate noise of rate changes was irrelevant to the long-term outcome.
So why does everyone obsess over forecasts if they're so often wrong and tied to proximate noise?
That's the million-dollar question, isn't it? Even pros admit short-term markets are unpredictable. Remember Harry Dent Jr., great, calls on Japan, the dot-com bust, then totally wrong, calling for a crash in May 2020 when the market surged.
Yet the industry churns out forecasts constantly.
It's partly incentives advisors feel they need to look busy and predictive, and partly psychology. Having a forecast gives a false sense of comfort, a feeling of control, even if it's totally baseless.
And chasing thematic forecasts is just as bad, like the EV boom.
Oh yeah. Remember Nikola, valued in billions with no real tech or revenue. Pure hype based on approximate theme, electric vehicles. Or this obsession with total addressable market, TAM.
TAM seems important, shows the potential.
It's mostly useless, as Prasad puts it. A huge market doesn't mean anyone will make money, let alone who. The U.S. apparel market is enormous, $370 billion TAM. How many clothing companies went bankrupt during COVID? Loads. Big market, fierce competition, hard to profit. TAM tells you almost nothing about profitability.
Even company-specific news can be just noise, like Vaibhav Global.
Good example. They sell low-priced jewelry. Stock dropped because of fixable issues. They weren't doing installment payments yet, some management gaps, proximate problems.
But the underlying business was okay.
Fundamentally sound. So a lazy investor focused on the ultimate quality would hold through that noise, and Nalanda did. And the investment worked out very well eventually. Distinguishing temporary fixable noise from permanent damage is key.
It comes back to that idea. If you held a broad market fund through the 2008 crash, did nothing, you'd have multiplied your money many times over by 2022.
21 times. Far better than the index itself. The ultimate cause is compounding. Business resilience beat the proximate panic. Doing nothing was the winning move.
Okay, this leads to the idea that business stasis is the default. That sounds weird. Isn't business all about change and disruption?
That's the popular narrative, but the evidence suggests otherwise. Stephen Jay Gould's biology theory of punctuated equilibrium applies surprisingly well.
Which says?
Evolution isn't constant, slow change. It's long periods of stability stasis broken up by short bursts of rapid change.
And businesses are like that.
Largely, yes. Great businesses tend to stay great. Bad businesses tend to stay bad. Most companies exist in a state of relative stability for long periods.
Is there data for that?
Yeah, look at the Fortune 500 from 1955 to 2015. About 40% of the original companies, or their direct successors, were still significant players 60 years later. Creative destruction happens, but maybe slower than we think. Companies like Eaton, USG, they showed incredible resilience.
And industries are getting more concentrated, top players getting stronger.
Trend since the 90s. In most U.S. industries, the leaders have gained market share, higher profits, more power. This reinforces the idea of stasis. The winners tend to keep winning.
So for an investor, this means
your default should be not buying. Be a lazy buyer. Only act when you find a truly high-quality business you believe can stay in stasis for decades and once you own it.
Be a very lazy seller. Don't touch it.
Exactly.
And the underpinning for that laziness is the crazy power of compounding, right? The rabbit problem.
The rabbits in Australia. It's an astonishing story. Thomas Austin releases just 24 rabbits in 1859.
They basically took over the continent.
Pretty much. By 1925, estimates were 10 billion rabbits. That came from an average growth rate of about 35% a year.
Shows how compounding starts slow and then just explodes.
Precisely. And investors often miss the explosion because they sell too early. Getting 3x your money in 5 years feels great, so you sell.
But if that 3x rate continued...
For 25 years, that same rate doesn't give you 15x, 3x times 5 periods. It gives you 243x. The biggest gains come late in the compounding cycle. And psychologically, it's hard to wait through the long, slow beginning.
Okay, so the argument is compelling. Why not selling is the best strategy? Let's break down the reasons. First, wealth creation is concentrated.
Hugely concentrated. That Besson-Binder study is crucial, found that just the top 1% of companies generated almost three-quarters, 74% of all the stock market wealth over many decades. And the median time those top companies were held to generate that wealth, 47 years.
47 years. So you have to hold the great ones for a very, very long time, like Shelby Cullum Davis did with insurance stocks.
Perfect example. He became a billionaire by buying good insurance companies cheap and just holding them for decades. He understood their hidden float, the premiums they invest before paying claims, and just let compounding work its magic. He almost never sold.
Reason two for not selling: taxes and missing the best days.
Right. Selling triggers capital gains tax, which immediately cuts into your compounding base. Plus, study after study shows that market returns are dominated by a tiny number of really big up days.
If you're out of the market on those few days.
You miss a huge chunk, maybe even all, of the long-term gain. The book shows data for Havells and Page Industries days, with 5% plus gains accounted for over 100% of the total return over years. Missing just a handful of those days devastates your results. You have to be invested to capture them.
Third reason: relationships.
Yeah, being a long-term owner lets you build real trust and understanding with management. You get insights you just can't get as a short-term trader. You become more like a partner.
And fourth, not selling frees you up.
To become a better buyer. If you're not constantly agonizing over when to sell, you have so much more mental energy and time to research and prepare for the next great buying opportunity.
Like during a market crash.
Exactly. Nalanda was able to deploy $288 million in just 17 days during the March 2020 COVID crash, precisely because they were prepared. They weren't distracted by selling decisions. They were ready to buy quality when it went on sale. Inactivity in selling fuels preparedness in buying.
Okay, but people will object. What about holding a stock when its PE ratio hits 60? Surely you sell then. It doesn't make sense to hold at 60 PE.
It's a common reaction. The book uses Ratnamani as an example. Nalanda bought it relatively cheap, 128 INR. It ran up, then stalled around 700 INR for 2 years. High PE seemed stuck.
Most people would have sold thinking the easy money was made.
Probably. But the business was still excellent high ROCE, no debt. They held. By Jan 2021, it hit 1,600 INR. The overall return over 10 years was 29% annualized. Holding through that high PE period was crucial for capturing the long-term gain. Quality eventually justifies valuation if you wait long enough.
What about the "my incremental return will be low from now on" argument? Feeling like you need to redeploy capital for better future returns.
Prasad shares a personal mistake here, selling Shree Cement, the cyclical company, after it doubled in less than a year. He thought he was being clever, playing the cycle.
But he missed out on more gains later.
Much more. He realized that trying to be smart and time the cycle cost him dearly. High turnover, constantly chasing the next best incremental return, often leads to lower overall returns. It correlates strongly with fund underperformance.
Which leads to the final, maybe existential objection: what should I do the whole day if I'm not trading and not reacting?
It's a funny question, but revealing. Investing is maybe unique in that inactivity is often the most productive path. Being lazy, very lazy, means you stop reacting to noise and focus your energy on what truly matters. Identifying exceptional businesses initially and then letting them compound. The hard work is up front and then in the discipline of doing nothing.
So, wrapping this all up, we started with the bumblebee's caution, and you mentioned ending with the honeybee.
Yeah, the honeybee succeeds through collective, consistent repetition of a simple process. It's not about individual genius on every flight. And just like science advanced when it acknowledged its circle of ignorance, realizing how much it didn't know before discovering DNA investing well requires humility about what we can't predict.
Acknowledging what we don't know is key.
Absolutely.
Us.
And the ultimate wisdom, the core lesson maybe, is that observation Prasad makes. Everyone sees immeasurable wealth being created by people who never sell, but they think and act as if it is selling that creates wealth.
That's powerful. We see the evidence of buy and hold fortunes, but our actions default to trading.
It's a deep psychological bias towards action, towards feeling in control.
So for our final provocative thought, the cicadas.
Yeah, think about periodical cicadas. They spend 17 years underground, waiting for one brief, life-defining event emergence, mating, laying eggs for the next generation. Their entire strategy is extreme patience for a singular long-term payoff.
17 years of doing nothing, basically, to achieve their ultimate purpose.
Exactly. So the question for you, the listener, is How much more patient, how much more disciplined can you be? Can you resist the constant noise, the urge to act? Can you recognize that true, lasting wealth is often built not by frantic activity, but by patient, long-term inactivity with the right businesses? Hopefully, this deep dive gives you some principles to do less, but do it much, much better.